Hello and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. In this edition, we are going to take a no-holds-barred look at the recent consultation paper released by capital markets regulator Sebi. A careful reading of the paper, which is a follow-up of the FM's budget statement that Sebi will consider, and in capital letters consider, mandating again in capital letters, beginning with large corporates to meet about 1/4 of their financing needs from the debt market, suggests that Sebi, like the Reserve Bank of India before it, has made up its mind about the desirability of making corporates borrow from the bond market rather than from banks. Why do I say this? Because though it is called a consultation paper, the public has been given less than a month to send in its comments, apart from which the tone and tenor of the paper suggests that Sebi will not brook any argument. The intention of the budget statement, says the paper, is to nudge, again in capital letters, corporates to access the bond market, and Sebi will do more than nudge. It will compel and will impose penalties if they don't approach the bond market. But is it any of Sebi's business to mandate or even nudge corporates in the matter of how they raise their funds? Is this not something that is best left to the commercial judgment of the individual corporates? The regulator's job, to my mind, should be limited to facilitating fundraising in a fair and transparent manner, whether through debt or equity. The rest should be left to corporates. Surely they don't need to be told how to manage their businesses, least of all by regulators who really have only theoretical knowledge. And that's what we're going to discuss in this with our panel of experts, G. Padmanabhan, former Executive Director, Reserve Bank of India, and N.S. Venkatesh, former Chairman, FIMDA, Fixed Income, Money Markets and Derivatives Association of India, and presently CEO AMFI, Association of Mutual Funds of India. Venkatesh, in your case particularly, I know it's a little difficult for you to criticize Sebi in your new role, and I'm being a little provocative, but I do want you to be frank on this show. Welcome to the show, Padmanabhan and Venkatesh. To my understanding, the word consider means discussing the pros and cons. But here we have a situation where Sebi, supposedly an independent regulator, seems to have fallen in line with government's unstated wishes and considered largely only the pros. Its consultation paper is to be believed. Sebi is all set to mandate that large corporates, the paper defines these as having a certain threshold of outstanding borrowings, 100 crores in this case, a reasonable credit rating, AA, intends to raise funds of more than 1 year and has listed securities on stock exchange. The last presumably is because Sebi regulates only listed companies. It mandates that they should raise 1/4 of their financing needs from the bond market. So my first question to both of you is that should the regulator, as I said in my intro, be in the business of mandating how companies finance their business, or is that something that is best left to the judgment of the companies themselves? Let me start with you, Padmanabhan.
Good morning, Mythili. As usual, I think you started with a very provocative question, and let me try to address this in the following way. I think more than the mandate, we need to look at the intention behind the Reserve Bank of India earlier and now Sebi coming out with some kind of regulations on how the fundraising has to happen. I think the intention is more to do twofold. I would say from a regulatory perspective, the Reserve Bank perspective, it's about de-risking the banks, and from the Sebi perspective, more than the fundraising per se, which is what is stated on paper, the unsaid aspect is a missing market, I think, which the regulators have been trying to develop. Probably that was the missing market when I joined Reserve Bank of India in 1979, and now that I've left Reserve Bank of India 3 years ago and leaving the next role in Bank of India also, we are still talking about the same missing market. So I think it has more to do with how they go about developing a market, but it's a fair point to say that to my mind in this country, anything which has been done through a mandate and which causes difficulties at the ground level or is not accepted as a logical business proposition very often has not taken off.
For agreeing with me, at least to that limited extent. Venkatesh, would you agree? Because I find it a little strange that we say that in a deregulated, market-driven economy, we say we're deregulated, market-driven, etc. But whether it is Sebi or the Reserve Bank of India, whenever it suits the regulator, we talk of mandating rather than allowing market signals to operate. Thus, we have the RBI mandating that banks should levy interest on loans at the MCLR, marginal cost-based lending rates, and now Sebi telling borrowers how and where they should borrow. Are we going back to the pre-reform period, Venkatesh?
No, I don't agree to that sort of an aspect. I would put it in a different way. I would say that they have that is SEBI has a mandate of development of markets, and Reserve Bank of India has a mandate of looking at the overall banking sector, the health of the banking sector. So looking at where the banking sector has gone in the last couple of years, so they are only, like I agree with Mr. Padmanabhan, that they are only trying to de-risk the bank balance sheet. So to that much extent, they are trying to move away a part of the borrowings of the corporates from the bank balance sheets and making the bank balance sheets available to people who do not have access to the markets. So these people have access to the market, so they are only trying to tell them that since you have an access to the market, why don't you go to that preferred access to the market, at least to the extent of 25% of your borrowing. That is what is happening from both Reserve Bank of India and SEBI. And I would say it's rightfully so, because we have been talking about the development of the corporate bond market since long, because from 92 itself we have been hearing this when the market got liberalized and all those things, and it has been going on like with the RH Patil committee and all other committees who have discussed, deliberated and all those things. So I think it's only a nudge which is happening. Globally, if you see, regulators do tend to nudge for the development of markets, and I think that is what exactly happening in India. So we should give credit to the regulators in the sense that they are nudging people to go into the market, except for the fact that maybe you are putting it as a mandate. I would say that they are nudging it to go into the right lines, so that other people, other investors who are there could also participate in the corporate growth story.
I would agree with you, Venkatesh, except that we're talking about Indian corporates who are very sharp, and if they thought the corporate bond market was more attractive, they would automatically go towards it. You don't need a nudge from SEBI. SEBI's job should be limited to facilitating the market development. In fact, Padmanabhan, the paper points to how the share of bond financing overtook that of bank financing in 2016-17, overlooking the fact that 2016-17 was a year when bank credit grew at just about 5%, the slowest in 60 years. In fact, more recent data shows that in the 6 months to June 2018, bond sales fell 34% relative to the same period last year, the biggest fall in the last 1.5 decades. Of course, the picture might be a little muddied by the fact that bank credit did grow relatively faster in the last 6 months. But the point that I wish to come to is that if, as SEBI says, the bond market is already proving so attractive, then why, pray, does it need a nudge? In fact, a shove, if I put it that way. Why is SEBI taking a leaf out of a book of your former employee, RBI, and just very prone to micromanaging and doing the same? Padmanabhan?
Well, Mythili, I wouldn't go to the extent of calling this micromanaging, but I would probably set out what are my concerns about what differentiates between what you call nudge in capital letters and what Venkatesh thinks is probably not in capital letters but in small letters. I think one issue is if you are talking about de-risking of the banking system, that's a fair call that the regulator will have to take. But a risk to the banking system, the regulator of the banking system thinks the threshold to start with is 25,000 crores, which over 3 years comes down to 10,000 crores. Now, straight away that limit gets reduced to 100 crores for defining the large borrowers as far as the SEBI is concerned. Now, I think 100 crores being categorized as a large borrower in an economy like ours, I think is probably asking most of them to go to the corporate debt market. Now, that has another issue, because to start with today they say that it is the well-rated corporates or the AA plus who goes to the market based on the SEBI data that whoever has gone to the market till now is AA rated. I do not know whether that should be the basis for deciding what should be the rating. But I think SEBI is probably having the issue that if the investors into this, for instance, let us assume that for all the good reasons they go to the market, like today the problem that the banks have been facing is the mismatch, the asset liability mismatches in their balance sheet, because basically if you are talking about longer term funds being raised from the capital market and banks do not have that kind of liability profile to to be funding these loans, then it's fair that the investors must be those people who have the long-term funds. But I think the issue that today, when they put out the paper, the Sebi is also facing, and I'm presuming this, is that the other sectoral regulators who have to authorize their entities to go and invest into this market are still being reasonably conservative about this rating. So somewhere they have made this start, but the outcome of this would be, if we are going to mandate this, and looking at it from a bank perspective, now that I am chairing a bank, is that AA plus all incremental credit goes to the capital market. So overall, the quality of my credit portfolio, which is already under stress, I would worry that that quality would go down further if this is going to take off.
You've made a number of very relevant points, Padmanabhan, and the fact is, where is the demand going to come from, and will there not be cherry picking as far as banks are concerned? So Venkatesh, the same issue I come back to again and again, that shouldn't the regulator confine itself to facilitating trading, facilitating corporate bond markets through things like a dedicated debt segment in the exchanges, ensuring reporting of OTC over-the-counter trades and bonds, ensuring greater transparency, etc. Also, both the RBI and now Sebi seem completely enamored of the bond market-led financing model as compared to bank-led financing. But there are many examples all over the world of bank-led financing, Germany, Japan, China, to mention just three. So what explains this fascination with bond financing? Is it simply that we tend to blindly follow whatever is fashionable in the West, especially the US, Venkatesh?
Essentially, when you look at the market development, you need the corporate bond markets to develop. And the bankers are supposed to take care of the retail and the SME sort of segments, and the corporates who have market access should go to the market. Here what is happening is, maybe the bankers are themselves giving funds to the corporates, and it is becoming an easy way of banking. So because of which what has happened is, the market for corporate bond has not developed at all, and which is starving off the funds to the, let us say, the SMEs and the retail sort of levels, and it is adding to the risk, which we saw a couple of years back. The risk has actually increased on the bank balance sheets, which has resulted in most of the banks having being saddled with all the NPLs that we are seeing. So what we are trying to say is, we are trying to diversify that risk to the ultimate provider of funds, whether to the bank or to the corporate through the bond market. So I think that is where I think the regulators are looking at. Yes, I do agree that in Germany or in China or Japan, the bank loan market is far in excess of the bond market, but still there also the bond markets are equally active. So what Sebi is trying to say is, take that 15-17% to 25%, so that it gives a nudge. And if you look at Sebi, they are facilitated through the, let us say, the tripartite repo, which has just now been announced with NSE and BSE taking lead onto that. So that will bring some liquidity into the secondary markets. They have brought in the electronic bidding platform. They have brought in the repository the corporate bond repositories into the exchanges. So I think they are facilitating the development of the market. Here it is an additional nudge which is being given.
Venkatesh, your point about Sebi having done a great deal to promote the bond market is entirely correct. It has done a great deal to facilitate trade. But the question is, should it just limit itself to facilitating, or should it hold a gun to the head of corporates, and not just corporates, also the investing public? Because ultimately it is the investing public who are the savers and who provide the funds for these corporate bonds. But I'm afraid it's time for us to slip into a very short break. Please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and I'm in discussion with G. Padmanabhan and Agnes Venkatesh on the merits, demerits of Sebi's latest paper, almost mandating large corporates to go to the corporate bond market to raise 25% of their long-term borrowings. Padmanabhan, even if the paper makes a strong pitch for corporate bonds, it points to how it is only the better-rated corporates that are able to tap the market for corporate bonds. 90% of the issuances, it says, are of AA rated or above, and declares that BBB or equivalent are also investment grade. So government and the regulators will take necessary action to ensure that these lower rated corporates are also able to raise funds through bonds. Is there some kind of a veiled threat that institutional investors will be arm twisted into buying lower rated securities? And is that not a very dangerous trend?
Well, I think that issue, I don't think honestly that we are aggravating a situation, because today also, whether there is a corporate debt market or not, I think these institutional investors invest in those companies where the banks have invested, and probably are facing the same kind of issues, although there are no AQRs that are run on LICs and other things like that. So that's something that we need to say, that I would think that that's not aggravating a situation. But actually in this whole process, there are couple of issues which I would caution about right up front in my own perception. The first one is that the kind of statistics that we are looking at and the kind of conclusions that we are drawing as far as the importance or the popularity of the corporate debt market, I think it's slightly overplayed, for the simple reason that we are looking at a period where most of the banks were having constraints and they were not even extending the credit where it was due. So the corporates obviously turned to alternate financing model, and because those numbers have shot up, their fancy for the corporate debt market, to me it will be too early to conclude that has happened, because banks, I think at least for the last year or over, have been probably looking at underachievement as far as the numbers are concerned and profits are concerned, and overachievement as far as facing the accountability for their past actions are concerned. So this is the constraint that the banks have been facing. The second aspect that I would worry about is that what is the decision that we are going to take about the investment or the banks in the same corporate debt that is going to happen tomorrow. So if ultimately what we are going to achieve is the banks move away from taking an exposure on the corporate, which is being classified as loans and advances, into an investment category, I would probably say that we need to be a little bit cautious about it, because in terms of volatility in the balance sheet, those investments will have much more volatility than a loan.
Venkateshan, would you agree, if you were to market the holdings of banks in these corporate bonds, you're going to be hitting banks at a time when they're already very vulnerable. At the same time, isn't there a risk of cherry picking as far as MSMEs are concerned? They're going to find it even more difficult to access credit. In fact, the paper sets great store by credit enhancement, presumably guarantees or something of that sort, on the assumption that this will widen the market. But this has not really succeeded in the past. Even credit default swaps, even though they've been permitted, we find there's not much traction there either.
At this point of time, I would say that the interest rates are on an upward cycle. So that is where I think we are looking at the mark-to-market losses. But if the interest rates were supposed to fall in a falling interest rate cycle, then you will actually see the mark-to-market gains of the same bonds which the banks will take. But I tend to agree one point on what Padmanabhan says, that if it is only going to replace a loan with a bond, it is not going to serve the purpose. The purpose should be that the loans should come down, the loans to the corporate should come down, and the investment part should actually go into the other investors' hands and not into the banking sort of thing. Or the loans itself should come down substantially reduced, and a part of that can come into the banking book for the simple reason the banks need to have liquid securities for their LCR. So the liquid coverage ratios. So for that purposes, the AA and above bonds are treated as an liquid securities. So to that much extent, maybe they will be able to manage it from a liquidity angle. But for again proving the liquidity angle, you need to show that secondary market liquidity of that bond is required. So that is where I think, coming back to again what Padmanabhan said in the first instance, that you need to develop the secondary bond market so that there is more liquidity of trade.
Well, there's nothing wrong with being an optimist, Venkateshan. I hope you're right. But Padmanabhan, under the Companies Act, the fact is that non-financial entities are required to maintain a debenture redemption reserve fund. Presumably, this is because in order to ensure that the company is in a position to redeem its bonds or debentures whenever they are due. The paper, however, suggests doing away with the reserve fund on the ground that this raises costs. Coming from a regulator that has all along supposedly batted for the small investor, small saver, don't you find this a bit strange, Padmanabhan?
No, I think the logic, if I remember right, reading that paper they had given, is that the most of these placements in the corporate debt market has happened from the financial services sector, and the financial services sector is not required to maintain the reserve that you talked about. So they have not come to a conclusion, but they're drawing this example to say that probably this would mean that since the cost of raising this money in the market is lower for these entities, they are encouraged to move to the market more. But whether it raises a risk issue, well, one way of looking at it is redemption reserve is like your capital or your cash reserve or whatever you call it. Now, in a pure risk scenario, if you ask me if there is a bust and whether this money will be enough to take care of the claims of the investors, I would say no. But probably this is sort of limiting the leveraging that they are able to do by asking this money to be put in a reserve. So I would be sort of neutral, because I would go ahead and see how this works out when the whole thing develops. Once we are very serious about taking this forward and we are able to remove all the obstacles and bring people on board, then I would say it's extremely important that we ensure the quality of the credit rating and the credit rating agencies. Otherwise, that'll be another area which could snowball into problems later.
Yes, indeed. The paper reflects a very touching faith in rating agencies, which is quite strange given the kind of track record. I must say these rating agencies seem to bear a charmed life. But the paper also, Venkatesh, talks about how the IBC, the Insolvency and Bankruptcy Code, has addressed the default risks of bonds, and this will help deepen the bond market, it says. But the reality really is that the IBC does not quite help bondholders. In fact, they are not a part of the Committee of Creditors, and in the waterfall rank only 4th. So is the paper guilty of presenting an unduly rosy picture?
No, I think they have actually defined that waterfall mechanism in a way that what they are trying to say is that the bondholders are unsecured. If it is an unsecured bond, it is an unsecured creditor. If it is a secured bond, definitely they are a secured creditor to that matter. So as an unsecured creditor, they even now rank above the government claims. That is what they are trying to say, compared to the earlier waterfall mechanism where government claims take a precedence over the unsecured creditor. So to that much extent, there is a little bit of a positiveness for the unsecured creditor, and that is where I would say the bondholders get a little bit of a relief. You are talking about the debenture redemption reserve. I would say that the debenture redemption reserve is applicable only for manufacturing companies and all those things. So maybe why this difference between, let us say, a financial sector and a real sector? So what they are trying to say is the real sector also should come on par with the financial sector, and the rating of that particular bond should reflect the underlying credit risk rather than the debenture redemption reserve or the sinking fund covenant that is being put in. So ultimately you put a sinking fund covenant, and they have to actually keep that money aside every year out of their profits. So that's a futuristic view of the cash flows that can happen. That in any case will be factored in by the rating agencies when they give the rating. So it is like a over collateralizations and those sort of things. So I personally believe that the rating agencies will have to play a very, very big role, like Mr. Padmanabhan is telling, and rating agencies have to really come out with the right amount of ratings, and the pricing has to be based on risk-based perception rather than the competition-based pricing, because currently it is all competition-based pricing, that the competitor is willing to take it at a lower yield, so I will also take it at a lower yield. It should not be like that.
Yes, indeed. In fact, the paper assumes many things. The question is that do we have the supporting infrastructure in place? Today, the reality is that if a corporate defaults, there is very little recourse for investors. We saw what happened to investors in the JP Morgan fund when Amtech Auto defaulted on its 800 crore debt. And if that is the fate of institutional investors, what can retail investors really expect? Given the legal delays in India, going to court is hardly an option. Would you, for instance, buy a corporate bond, or would you prefer to stick with the safe fixed deposits of a nationalized bank in particular?
Well, I think you and I represent probably the conservative part of the majority. There would be people who would be interested in going ahead and investing this if the market develops. So in fact, Mythili, this would be the least of the issues I would be worried about. I think both in terms of the demand, yes, the demand has not been coming, and we have been talking about numbers. All these numbers, as I'm repeating, they are just primary numbers. I mean, unless there is liquidity, as Venkatesh put it, unless the liquidity comes about, I don't think the serious investors are going to put their money and lock it. And because in a capital market, when when the FPIs and others are the major players, I'm afraid there is no held to maturity concept at all. Everything they must be able to have liquidity, and this is where fundamentally the problem is going to come about. But I wouldn't worry too much about the infrastructure, because the infrastructure always catches up. I mean, who would have thought that probably in the capital market we would have had the kind of infrastructure that we have developed, and whether we today I think that's being agreed, or everybody accepts that that's a world-class infrastructure. In terms of infrastructure we are talking about. So I wouldn't worry too much about the infrastructure. That would catch up. About the investors who would invest in, unless we are able to bring all this in place in such a way that it is not merely the initial issue, but the real trading and the secondary market happens, these are the challenges, and that's why this remains a missing market for several number of years. And having said that, I don't think we have too many corporate debt markets around the world which are really thriving and active. There are very few large markets, and most of them in very developed countries.
Well, I couldn't agree with you more, but Sebi and the Reserve Bank of India clearly think quite differently. I'm very much more skeptical on the entire issue, but clearly both Padmanabhan and Venkatesh seem to think that the regulators should be given a longer rope. Let's see how things pan out in the months to come. Thank you so much, Padmanabhan and Venkatesh, for joining me in the discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.